Welcome to the latest edition of our Tax Credits and Incentives Advisory Podcast, entitled Hot Topics and Cost Segregation. My name is Marty Cameron. I'm the head of our National Tax Credits and Incentives Advisory Group here at Cherry Beckert Advisory. And today, we will cover some things to consider as you make capital investments in buildings, structures, and energy-efficient property. Specifically, we're going to talk about cost segregation in 179D. Cost segregation is a commonly used tool that allows taxpayers who've constructed, purchased, expanded, or remodeled any kind of real estate to increase cash flow by accelerating depreciation deductions and deferring federal and state income taxes. This really is a follow-up to a client panel we recently led, which is available on our website. And with me today is Ron Wainwright, my partner in our Tax Credits and Incentives Advisory Group here at Cherry Beckert, and also Sean O'Leary, the senior manager in our group. Ron, how are you and where are you today?
Marty, I am in Raleigh, North Carolina, and doing very well. And we appreciate everyone listening, following up on our TCIA summit.
Sean, where are you today and how's it going?
I'm doing great, Marty. Thank you. I'm in my home of Charlotte, North Carolina, and things are going great. It's a little hot and humid outside, but we're doing great here.
Very good. Okay, so why don't we get into it? Ron, just to level set, what is cost segregation and why should taxpayers consider the incentive?
So Marty, excellent question. Just as a reminder, cost segregation is a process, an engineering process specifically, where we look at a commercial or multi-residential or residential building, and we separate that building cost between real property and what is deferred or referred to as personal property. Why do we do that? We do that because the tax law says that you will depreciate over straight line, either 39 years or 27 and a half years if we're dealing with a multi-residential property. And so what cost segregation is about is dividing, componentizing that building, that structure between real property and personal property. We want to make sure that we are utilizing the shorter life assets that can be depreciated much faster and therefore accelerate the depreciation expense into earlier years, which ultimately drives that taxable income and saves the taxpayer cash, which in turn they can reinvest. And so very important because as we move and divide 1250 and 1245 property, as it's referred to, 1245 being the personal property piece, we're now using makers as opposed to straight line, and we are using class lives that are much shorter. As we will have a question later, then we get into some considerations for bonus depreciation. Clearly, taxpayers, as a reminder, should consider this opportunity from an incentive is anytime they invest in real property, again, whether that's a commercial building, whether that is a multi-residential or residential, as well as when they're expanding any of those type of structures. So you drive that depreciation in the early years, taming that tax benefit, accelerating it over 39 or 27 and a half years. So again, upfront cash savings and incentive that can be invested immediately into other income producing opportunities or properties, which ultimately will grow over time. So there ultimately is not just a timing element to the planning opportunity, but really a permanent difference as we are utilizing the accelerated depreciation.
Sean, Ron just made a reference to bonus depreciation. Can you go through the rules around bonus depreciation, what it is, and how it helps taxpayers with the cost seg study?
Sure. So bonus depreciation is a method of depreciation that allows a taxpayer to expense the cost of the property in the year that it was placed in service, instead of recovering the cost through traditional cost recovery depreciation methods, which calculate a yearly deduction over many years. Allowing a taxpayer to expense the cost of a fixed asset is an important incentive, and as Ron mentioned, it accelerates the tax depreciation into the current years and reduces the upfront cost of acquiring the property. Bonus depreciation is an important part of cost segregation. It supercharges the tax benefits of of segregating a building's assets into real and personal property components. From a tax law perspective, bonus depreciation, has really had a long history. Congress first introduced bonus depreciation way back in 2001 as a way to incentivize the business community to acquire personal property, which is, equipment, vehicles, computers, that sort of thing. And since then, bonus depreciation has come and gone from the tax code numerous times, and the rate of bonus depreciation has fluctuated from the low of 30% to the high of 100% of the amount of an asset that can be immediately expensed. Currently, and since 2018, as codified by the Tax Cuts and Jobs Act, the bonus depreciation rate is set at 100% and will remain there through the end of this year. As of now, in 2023, the rate then reduces to 80% and gradually scales down to 20% for the 2026 tax year. Historically, bonus depreciation only applied to personal property, which simply stated are assets like machinery and equipment, furniture and fixtures, and certain land improvements like parking lots or sidewalks. Excluded from this definition is real property or the structural part of a building like the concrete and steel. This has changed a bit in recent years with a new class of property called qualified improvement property, which is now a carve out of the real property of a building and is now eligible for bonus depreciation. But Ron's going to talk about that a little bit later. Another big change that has impacted bonus depreciation from the Tax Cuts and Jobs Act was for the first time allowing bonus depreciation to be applied to used property, which means that a taxpayer could now purchase an older building and claim bonus depreciation on the personal property portions, or stated differently, expense those portions of the building in the year acquired. This greatly expanded the utilization of bonus depreciation for real estate investors in cost segregation studies and amped up the immediate tax benefits as well. So now, again, through the end of this year, the bonus depreciation provisions of the tax code allow 100% of the cost of the property expensed on nearly every physical asset a taxpayer acquires within a building, except the structural portions of a building originally acquired or improved. This is really a powerful tax incentive that is widely utilized in cost segregation studies, and again, helps taxpayers reduce their upfront tax liability.
So Ron, Sean mentioned the concept of qualified improvement property. Do you want to go through that concept for our listeners?
Sure, Marty. And as you know, there's often a lot of confusion out there as to what is in fact qualified improvement property. So in the prior question, I answered what is cost seg, where we're actually segregating the building between personal property being 1245 and real property being Section 1250. So when you think about qualified improvement property, by definition, it's an improvement to Section 1250 property that the taxpayer has made to the interior portion of a building that basically has been placed in service after the date of the building being placed in service, or in our cost segregation, we actually identify areas of the building prior to being placed in service. So when you think about qualified improvement property, what's often misunderstood is, well, when we talk about improvements in 1250 and interior portions, what are we really talking about? And so some examples for you all around qualified improvement property is interior doors, interior air conditioning and HVAC systems, water heaters, security upgrades, fire protection systems, interior electrical, water lines, plumbing, painting, carpeting, shelving, etc. So you could begin to see a significant opportunity in regards to segregating that additional 1250 property, because 1250 property is the property we're depreciating at the end of a cost segregation study, straight line over 39 or 27 and a half years. One other area of confusion is that qualified improvement property is technically a class life of 15 years, which there was a technical error in the Tax Reform Act of 2017 that ultimately was corrected which left 1250 in qualified improvement property into that 39-year life. So there's a number of provisions out there, which is often overlooked and confused, where you can go back and identify that qualified improvement property. And because it falls into that 15-year correction of the statute, you get to basically use makers. But then again, to Sean's comments on bonus depreciation, you can immediately expense the qualified improvement property. So think about all those interior doors and that security upgrade, or those interior water heaters or interior electrical. So when we think about qualified improvement property, this is another area that we do qualified improvement property analysis on a building or structure that may have been placed in service 2 or 3 years ago. But a significant opportunity to accelerate immediately, again, depreciation, creating not only a time value of money savings, but ultimately over that 27.5-year life, if you net present back, you would ultimately have a permanent tax savings for you in qualified improvement property.
Okay, thanks so much, Ron. That's excellent. I know from a recent development perspective, one of the most important things that's happened recently is the update to the Audit Technique Guidelines for both cost segregation and 179D. And I'm wondering if both of you could comment on how important that is and how that's going to affect our practice, and how it's going to affect the ability to take cost seg and 179D for our clients.
Sean, why don't you take cost seg, and I'll speak or add on some comments, but I'll also speak to 179 Cap D. Both of these, by the way, were released in the last several months. 179 Cap D on May 26th, and then the Audit Technique Guideline for cost seg in June.
Sure. Thanks, Ron. So as you mentioned, just last month, the IRS did release an updated version of its Audit Technique Guideline as it pertains to cost seg studies. Much of this guidance was really unchanged from the prior version of the ATG that was issued, back in 2016. But the updated guideline does highlight many of the significant tax law changes that have occurred since 2016 in relation to depreciation in general. Specifically, as we've talked about a little bit, the PATH Act of 2015, the Tax Cuts and Jobs Act of 2017, and the CARES Act of 2020. As I mentioned, several of these law changes have already been mentioned, but probably on a high level worth mentioning again. So the Tax Cuts and Jobs Act changed the bonus depreciation rate to 100% for tax years 2018 through 2022, and then the rate goes back down to 80% next year in 2023, and then further declines in years beyond that. So going to 100% bonus depreciation again is a huge change that greatly incentivizes taxpayers to make investments in both real and personal property. And the other significant change from the TCGA was for the first time allowing bonus depreciation to be claimed on used property. And as Ron mentioned, the other significant tax law change as of late came from the CARES Act in 2020, which again was a technical correction of qualified improvement property into a 15-year asset class, which then qualified it again for bonus depreciation. So lots of tax law changes were highlighted in the ATG, but they also did point out a number of other important points for taxpayers utilizing cost segregation services for their real property investments to consider. The IRS points out that there are numerous ways to conduct a cost segregation study, but emphasizes that the, quote, detailed engineering approach is the most accurate, and frankly is the one that we use for our projects at Cherry Bekaert. Other approaches can be used, but may be scrutinized more heavily upon examination. Many cost seg practitioners rely on a, quote, rule of thumb study and simply apply average results of prior studies to a new property without doing a site visit or closely examining the actual cost of the building. The IRS is particularly disdainful of this approach and says it is, quote, typically sketchy and inadequate. So taxpayers should take a close look at the type of study being performed by their practitioner and be aware of the risks if audited. The audit guideline points out some other areas to watch for including evaluating the amount of a purchase price of a building that is allocated to land to ensure that the amount is reasonable. The IRS instructs that the land should be valued on its, quote, highest and best use, but practically and technically, taxpayers should also consider approaches that are justifiable and that can be documented. Many cost seg providers use standardized land values for every and all properties across the country. But really, from our experience, we recognize that land values are highly dependent on location. So land values in Miami, Washington, D.C., or Austin, Texas, are greatly inflated from those in smaller, less urban areas. Some other areas of concern pointed out in the ATG guide include, whether demolition costs of an older structure should be capitalized into land, which is not depreciable, or into the building for new construction projects, and whether the indirect costs spent on buildings during construction, for example, repairs and maintenance or indirect labor costs, should be capitalized under the uniform capitalization rules. In summary, the ATG is largely focused on recent tax law changes that we have discussed, but does offer a number of areas taxpayers utilizing cost segregation services should also be aware of.
Yeah, so Sean, really good overview from ATG on cost segregation, which was released June 1st. Let me make a couple additional comments. It is interesting to point out, and we will have 2 subsequent podcasts that'll talk more about the details of the Audit Technique Guidelines for both cost segregation and 179 Cap D. But dealing with the cost segregation ATG, it's interesting that there was a specific guidance pointed out around what is on the energy side of a cost segregation study and what they refer to as a new Chapter 8 called Electrical Distribution System. So if you compare the last version with the new version, there's clearly a push from the IRS perspective about educating not only practitioners from the standpoint of their audit technique guideline, but also those that are ultimately constructing or basically retrofitting the building as to come to some of the newer construction processes. As Sean correctly highlighted, due to a lot of tax law changes, the ATG and cost seg speaks just not only to the cost segregation methodologies, the engineering approach, which is the preferred approach, but talks to us a lot about changes in accounting methods, because 3115s are used if you're catching up to depreciation in a building that may have been placed in service, let's say 5 years ago. Detail analysis of bonus depreciation, which we talked about under 168K. And then it also talks about Section 179 expensing. And then 179 Cap D as well, Section 263A, the uniform capitalization provisions, 263 little a around the tangible property regs. So in the very voluminous audit technique guideline, it's clear that this is an area that, the IRS wants to ensure that, for example, where we provide a cost seg plus, as well as an audit ready deliverable to withstand any scrutiny. We are proud to tell you that when we reread the June 1st, that our studies were already fully compliant, and actually we do a lot more than what was outlined in the ATG. Again, we'll be having some additional podcasts, but one area, as Marty mentioned, in a hot topic, is we saw in May, the Internal Revenue Service issue a revised audit technique guideline into what is referred to as 179 Cap D, or the energy efficient commercial building deduction, which again is an opportunity to accelerate depreciation. For those that attended the summit, as a refresher, that when we talked about the energy provisions, and very large focus right now on energy or alternative energy, and 179 Cap D came underneath the Energy Policy Act of 2005. So it's been out there quite some time, but what it stands for, and it's permanent in the law, is to incent a architect as well as an engineer, or really any designer, to design a building more energy efficient. And so 2 key areas, broad keys, that I'd point out, and we'll get deeper into it in subsequent podcasts, is there is now an inflation adjustment, which we all are very sensitive to the inflation. So now there's an inflation adjustment that can be taken into account in 179 Cap D and the energy efficient construction, as well as that there is confusion, or has been confusion, around, well, what is the ASHRA standard? And what are the most recent changes? So that is actually the standard which the energy efficiency deduction is measured against or modeled against. And there are very specific Treasury requirements. And candidly, it really hasn't changed a lot from 90.1 2000, really it's 7, which is what was in the Energy Policy Act, or really 90.1 2001, but now we're using basically 90.7. So that was kind of an increase in their scrutiny, because I think they found in examinations, and then they also highlighted an area that we have seen in other providers, is that the actual documentation of the 179 Cap D deduction, specifically if you're dealing with a governmental entity, has not been correctly completed pursuant to the regulations, which would cause some disallowance. So stay tuned for those additional podcasts in regards to the Audit Technique Guideline and 179 Cap D. But from our perspective, we welcome those Audit Technique Guidelines, because very similar to our cost seg review, when we reviewed the new 179 Cap D standards and the Audit Technique Guideline, and there's actually 14 chapters. I would tell you that our deliverables, again, are audit ready deliverable, but we actually deliver a higher threshold than what the Audit Technique Guideline outlines, not only in cost seg, but also in 179 Cap D. So Marty, I'll turn it back over to you to wrap us up.
Yeah, thank you so much, Ron, and Sean as well. This was excellent today, so I really appreciate your time. I think it's been a good discussion for all our listeners. And for anyone listening, if you want more info on this topic or these topics, please feel free to go to our website at cbh.com. Additionally, please like, share, and subscribe to the Tax Credits and Incentives podcast. And thanks again for listening. Much appreciated.